Let's now move on to illustration 8, where we're going to touch upon the topic of cash generating unit. Earth Infra Limited has two cash generating units, A and B. All right. What are cash generating units? Sometimes there might be assets which cannot generate cash flows on their own. All right. Sometimes there can be assets which cannot generate cash flows on their own. So for such assets, you won't be able to calculate value in use because that asset on a standalone basis is not going to be able to generate cash flows on its own. All right. So cash generating units refer to a group of assets. Cash generating unit refer to a group of assets which are capable of generating cash flows on their own. All right. Okay. Asset 1 is not able to generate cash flow on its own, but asset 1, 2, and 3 together can generate cash flows, and therefore 1, 2, and 3 together will be called as one CGU. It's called as a cash generating unit. It is a unit that is able to generate cash on its own. All right. For example, in process costing in CA Inter, you might have learned that one input will go into plant 1. From plant 1 it will go into plant 2, and from plant 2 it will go into plant 3, and after plant 3 you get the final output. In this case, plant 1, 2, and 3 together are responsible to produce the final output, and therefore plant 1, 2, and 3 together will be called as one cash generating unit. All right. Plant 1 cannot generate cash on its own because the output is not yet saleable. After plant 1 it has to be processed in 2 and 3. It's not saleable in the market after plant 1 is done, and therefore plant 1, 2, and 3 are said to be generating cash on an aggregate basis. All right. They're generating cash together, and therefore they will be called as a single cash generating unit. In such a way, Earth Infra Limited is said to have two cash generating units. Cash generating unit A will have certain plant and machinery. Cash generating unit B may have a certain other plant and machinery. There is no goodwill within the unit's carrying values. All right. There is no goodwill that is allocated to A and B. The carrying value of CGU A is 20 million and CGU B is 30 million. All right. So within CGU A, let's say there are 5 assets. The aggregate carrying amount of those 5 assets is 20 million. Same way in CGU B also, let's say there are 7 assets. The carrying amount of all those 7 assets together are 30 million. The company has an office building which is used as an office headquarter and has not been included in the above values. It is not included in these above values, and it can be allocated to the units on the basis of their carrying value. Now, typically, head office related building can never generate cash, right? Because head office is an administrative building. All right. The head office quarters or office headquarters is an administrative building, and that can never generate cash. All right. So that is called as a corporate asset. All right. It's called as a corporate asset. Basically, these are administrative assets. Now, what they're saying is administrative assets should be allocated for the purpose of impairment calculation to CGU A and CGU B to CGU A and CGU B in the ratio of their carrying values. All right. Because these corporate assets cannot generate cash on their own, what we do is we are saying that this head office is actually functioning for the benefit of A and B. All right. If head office does not exist, then obviously cash generating units also cannot exist because it's the head office which is actually taking the decisions of how to run A and B. All right. So what we're doing is the carrying amount of head office, we allocate it to A and B. We allocate it to A and B in the ratio of their carrying amounts. The office building has a carrying amount. Sorry, the office building has got a carrying amount of 10 million. The office building has got a carrying amount of 10 million, which we will allocate to A and B in the ratio of their carrying amounts. The recoverable amounts are based on value in use of 18 million for CGUA and 38 million for CGUB. Determine whether the carrying values of A and B are impaired or not. All right, let's start with step 1, which is allocation of corporate asset. So you have got CGU A and you've got CGU B. The carrying amount of CGU, if I take the carrying amount, it's 20 million and 30 million. All right, so it's 20 and rupees 30 million. I then add allocation of corporate asset. The corporate asset had a carrying amount of 10 million. I will be allocating it in the ratio of 20 is to 30. It had a carrying amount of 10 million. I'm going to allocate in the ratio of 20 is to 30. So that will be 20 by 50 and this will be 10 into 30 by 50. I'm allocating it in the ratio of 20 is to 30. So this will be 4 and this will be 6. All right. So this I'm allocating the carrying amount of the corporate asset in the ratio of 20 is to 30 and I'm allocating 4 million to CGU A and 6 million to CGU B. Why are we doing this? Corporate assets are basically administrative assets which exist for the benefit of other CGUs. If the office headquarters does not exist, then the CGU A and CGU B cannot actually function. The decisions on how to run CGU A and CGU B are taken at the head office quarters, and therefore what we are doing is we are saying that they are indirectly existing only for the benefit of CGU A and CGU B, and hence any carrying amount should actually be allocated to CGU A and CGU B. What the question stated is, it is a reasonable approach. It is a reasonable approach to allocate the carrying amount of this corporate asset in the ratio of the carrying amount of the CGUs itself. The carrying amount of the CGUs was 20 and 30, and we have allocated this 10 million in the ratio of 20 and 30, which amounts to 4 and 6. All right, so the total carrying amount of the CGUs after allocation is equal to 24 and 36. Now we will be comparing this with the recoverable amount of CGU, which was given as rupees 18 and 38 million. This was 18 million and this was 38 million. Therefore, impairment loss is going to be equal to carrying amount less recoverable amount, which in this case is 6 million. And over here, the recoverable amount is greater than the carrying amount. The carrying amount is lesser than the recoverable amount, or the recoverable amount is greater than the carrying amount. And therefore, there is going to be no impairment loss. All right. Remember, impairment loss is only charged when the recoverable amount is lesser than the carrying amount. All right. The recoverable amount is lesser than the carrying amount only for CGU A and not for CGU B. Therefore, impairment loss will not be charged for CGU B. Impairment loss will only be charged for CGU A. All right. Now, if you carefully give it a thought, the total carrying amount after the allocation was 24 million. We compared this 24 million with 18 million and we arrived at an impairment loss of 6 million rupees. This 24 million rupees is not the carrying amount of CGU A alone. It is CGU A carrying amount of 20 million plus the allocation of head office of 4 million rupees. All right, so the 24 million includes 4 million of head office quarters. If that is the case, don't you think that a portion of the 6 million is actually attributable to the head office quarters also? Because 6 million is based on the 24 million number. 24 million number includes 4 million of head office. Therefore, a portion of 6 million should also be allocated to the head office quarters. So this 6 million rupees is not going to be entirely a charge against CGU A assets of 20, but this 6 million will actually be allocated to both 20 and 4. The 6 million will be allocated to both CGU A standalone assets of 20 million, and a portion of that will also be allocated to the head office of 4 million rupees. All right, how are we going to allocate it? What we are going to do is allocation, or maybe let me just write it here. Allocation to CGU A is going to be 6 into 20 divided by 24, and allocation to corporate headquarters or corporate assets is going to be 6 into 4 divided by 24. All right. So since 4 out of 24 represents the proportion of corporate assets, a portion of that will be that proportion of 6 million will be allocated as impairment loss against the corporate assets. This will be 1 million. This will be 5 million. All right. So of this 6 million, 5 million will reduce the carrying amount of CGU A, which is going to make the carrying amount will as 20 less 5 equal to 15 million, and the corporate asset is going to get reduced by 1 million. The corporate assets total carrying amount was 10. 4 plus 6, that is going to get impaired by 1 million, and the corporate assets carrying amount will be 9 million. All right. So after charging impairment loss, carrying amount of CGU A will be equal to 20 less 5, that is equal to 15 million. Carrying amount of CGU B is actually not going to undergo a change because there was no impairment at all. So that is going to be equal to 30 million. And carrying amount of corporate asset or head office is going to be equal to 10 less 1 is equal to 9. All right, so the total carrying amount will be 15, 30, and 9. All right, what we did is the 10 million was allocated to CGU A and CGU B in the ratio of 4:6. Of that 4 million, 1 million is impaired. So 3 plus 6 is the revised allocation, and the carrying amount of the head office quarters is now equal to 9 million rupees. All right, let's actually quickly see the institute solution. So it's done. Carrying value after allocation is 24, 36, and the recoverable amount is 18 and 38. So impairment loss is going to be equal to 6. The impairment loss will be allocated on the basis of 4 by 24 to the building, so 1 million, and 20 by 24 to the other assets, which is basically this portion, that will be equal to 5 million. And the revised carrying amount will be 15 against A, B will be 30, and head office will be 9 million. All right, it will be 15, 30, and 9. That is going to be the revised carrying amount. All right, with that, we are done with illustration number 8.